Hey everyone! With BlockSonic, you get the top Bitcoin news of the day in a practical narrated format, so you never miss an important market move. With BlockSonic, you don't need to search for information. We find it for you. Today, the news dives into the heart of a crypto conundrum with our cover story, Crypto Crime Shock, $107.0 million laundered by Chinese ring. We'll unravel the complex web of a Chinese crime syndicate arrested in South Korea for allegedly laundering vast sums through unauthorized crypto exchanges. But that's just the beginning. We'll also explore the dramatic shakeup in the crypto world as a blockchain rollback sends Bitcoin's value tumbling, leaving the market in turmoil. How are tariff tensions and strategic investments influencing Bitcoin's stability and future? From ETFs gaining momentum to Wall Street's crypto awakening, we're on the pulse of every twist and turn. Join us as we navigate the volatile currents of the crypto market, uncovering the stories that are shaping tomorrow's financial landscape. Stay tuned. It's going to be an eye-opener. Bitcoin's value vanishes. Blockchain rollback shakes crypto world. A Starknet DEX glitch sparks Bitcoin's temporary disappearance and blockchain reversal. Paradex, a prominent decentralized exchange on Starknet, has initiated a rollback to block 1,604,710 after a data mishap led Bitcoin's value to plummet to zero on its platform, causing widespread liquidations. A member of the Paradex team communicated via Discord on Monday morning, noting that the complication arose following a database migration. Consequently, it was necessary to revert the chain to its state prior to this migration. All open orders will face forced cancellation, except for the TPSL orders, they further stated. The exchange resumed operations at 12:10 Coordinated Universal Time, after experiencing approximately 8 hours of downtime. Following the data error, Starknet's ERK token experienced a 3.6% decline in trading value. We at BlockSonic understand that these events highlight the intricate dance between technology and volatility within the crypto landscape. We at BlockSonic interpret that such rollbacks emphasize the fragility and resilience of decentralized systems. We at BlockSonic perceive that each block and transaction is a testament to the evolving nature of digital currency. How do these technological vulnerabilities impact your trust in cryptocurrency exchanges? Share your thoughts and engage in the ongoing conversation with us in the chat. Saylor, Unveiling the crypto maze, $100 million revelation. South Korean authorities bust massive crypto network in stunning turn of events. A trio of Chinese nationals have found themselves at the center of a whirlwind of allegations in South Korea, accused of laundering over $100 million in cryptocurrency. This revelation comes amidst a backdrop of regulatory discussions in a nation where digital assets have surged as a cornerstone of investment. The arrests underscore a significant regulatory challenge as South Korea grapples with establishing a coherent framework for cryptocurrency markets. Despite lacking stringent guidelines, local investors reportedly control billions of dollars in crypto, often held on international platforms, as noted by Aju Press. Unveiling the intricate operations of an international crime syndicate, South Korean customs authorities discovered a sophisticated scheme channeling millions through an unregulated crypto exchange. While the specific cryptocurrencies remain undisclosed, the Seoul Main Customs Office reported the group utilized platforms like WeChat and Alipay to orchestrate their financial maneuvers. The detained individuals, now awaiting prosecution, are believed to have maneuvered 148.9 billion won, equivalent to $107 million, between September 2021 and June of last year. They allegedly leveraged both domestic and international crypto accounts alongside South Korean banking networks. Authorities revealed the suspects masked the transfers as legitimate expenses, citing examples such as cosmetic surgeries for foreigners and educational costs for international students. By exploiting cross-border crypto purchases, they converted digital currency into Korean won, discreetly distributing funds through various bank accounts to elude financial scrutiny. We at BlockSonic understand that this case highlights the complex intersection of cryptocurrency and regulation. We at BlockSonic interpret that the absence of clear guidelines can create fertile ground for illicit activities, demanding enhanced transparency and oversight. How can nations balance regulatory measures with the innovative spirit of cryptocurrency to ensure both security and freedom? We invite you to engage and share your thoughts in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the video description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Bitcoin's golden promise faces storm amid tariff turmoil. Bitcoin's allure as the digital equivalent of gold faces turbulence. As the possibility of reaching $100,000 diminishes following tariff threats between the US and Europe. In a weekend twist, the U.S. administration declared plans to levy a new 10% tax on European nations resisting aspirations to govern Greenland, a territory of Denmark near North America. The European Union, vowing to safeguard Greenland's autonomy, rebuked these threats as detrimental to prosperity and market freedom. Amidst this geopolitical tension, traders on platforms like Polymarket dramatically reduced the likelihood of Bitcoin reaching $100,000. Data revealed a sharp decline in Yes shares, dropping from nearly 50% to 27% by Monday morning. Bitcoin's price dipped towards $92,000, stirring ripples across the cryptosphere. Indices for memcoins, the metaverse, computing, decentralized finance, and cultural tokens fell by over 7%. This mirrored declines in Asian and European equities, while gold soared to unprecedented heights, reinforcing its status as a safe haven. This scenario highlights Bitcoin's intertwined fate with equity markets, challenging its perception as digital gold. Bitcoin has seen a 5-day slide, unable to secure its position above $92,000. Remarked Saylor Hassan, a senior analyst at X.com. The downturn stems from profit-taking and a shift to risk-off sentiment amid rising political and trade uncertainties, Hassan elaborated. Despite current volatility, Bitcoin and Ethereum spot exchange-traded funds witnessed significant inflows, totaling $1.4 billion and over $500 million, respectively. This indicates growing institutional interest, as evidenced by an increase in large wallet holders by 28%, according to Geometrics. However, sustained momentum is crucial for a market rebound. Laser Digital emphasizes that the evolution of the tariff situation will dictate near-term price movements. Immediate price trends hinge on developments in the US-EU tariff dispute. Concurrently, geopolitical tensions in the Middle East are escalating, the firm shared with CoinDesk. The upcoming Davos Forum, alongside Kia's economic data, and a pending Supreme Court decision on the tariff legality will capture traders' attention, the firm noted. We at BlockSonic understand that these unfolding dynamics offer insights into the ever-evolving landscape of crypto assets. How do you interpret the current trajectory of Bitcoin amid such geopolitical influences? Share your thoughts and engage with us in the chat. Bitcoin tumbles below crucial support amid trade tensions. Crypto market pulse. Crypto assets take a hit as Bitcoin slides amid rumors of European Union tariffs in response to the United States unsettling the crypto realm. We at BlockSonic sense a ripple across the digital currency landscape as Bitcoin, valued at $93,001.66, alongside the larger crypto market, dipped on Monday. This shift followed murmurs of the European Union preparing and imposing 93 billion euros, which equals $110 million, in tariffs as a countermeasure to United States President Donald Trump's Greenland remark. These tariff jitters affected European equities and United States futures, while safe havens like gold and silver soared to unprecedented highs. Bitcoin, however, did not echo the upward trajectory of these precious metals, presently trading at $93,000, marking a 2.5% decline since 2300 hours Coordinated Universal Time on Sunday. Altcoins displayed varied outcomes, with the altcoin-rich CoinDesk 80 Index, abbreviated CD80, descending 4.64% over the past 24 hours. Since the stroke of midnight, it has fallen 0.93%, performing better than the Bitcoin-centric CoinDesk 20, abbreviated CD20, which is down by 2.5%. Bitcoin finds itself below the $94,500 support threshold after a fleeting surge on Wednesday, teetering on the brink of a range-bound path between $85,000 and $94,500, a pattern persisting since mid-November. We at BlockSonic understand that these fluctuations mirror the volatility inherent in the crypto world. As we navigate these shifting tides, what do you perceive the future holds for Bitcoin and its fellow cryptocurrencies? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin investment surge as Strive unlocks major funding channel. Strive stock soars, unlocking a powerful crypto funding channel as it surpasses the $100 mark. A $100 mark. Strive, a Bitcoin treasury company, witnessed its perpetual preferred equity known as SATA reaching a par value of $100 for the first time on Friday. This valuation enables Strive to sell additional stock, fueling further Bitcoin acquisitions. Strive's preferred stock delivers a 12% dividend rate, translating to an effective yield of 12.2%. Presently, Strive holds 12,797 Bitcoin in its treasury, while its common shares are priced at 94 cents. SATA mirrors the structure of strategies. Equivalent, stretch, and trading above par permits the company to issue more shares through an at-the-market sales channel, thereby raising funds to enhance its Bitcoin reserves. Stretch attained par earlier this month, with ongoing interest maintaining its value above that level last week. Data from Bitcoin Quant reveals that Stretch recorded a trading volume of $755 million last week, with $582 million of that volume occurring above par value. This represents the largest above $100 volume for any single week to date. Bitcoin Quant estimates that such consistent trading could allow Strategy to generate approximately 2,636 Bitcoin through the at-the-market program. On Friday, Strategy's executive chairman, Michael Saylor, commented with a probably nothing post on X, referencing the milestone of both Stretch and SATA reaching par. The remark underscores the importance of perpetual preferred equities trading above par data. We at BlockSonic perceive that these developments highlight a significant shift in funding dynamics for Bitcoin acquisitions, demonstrating the power of financial instruments in the crypto ecosystem. Does this milestone signal a new era of Bitcoin funding strategies? Share your thoughts and join the conversation in the chat. Bitcoin and Ethereum ETFs surge with renewed strength. Crypto ETFs witness a record inflow wave, sparking Bitcoin and Ethereum rally. Institutional investors are making their presence felt once more. United States-listed exchange-traded funds investing in Bitcoin and Ethereum drew in billions last week, marking their strongest week in 3 months. The 11 spot Bitcoin ETFs recorded a net inflow of $1.42 billion last week, the most substantial tally since the second week of October, as per data from TradingView.ai. BlackRock's spot ETF, IBIT alone, attracted inflows worth $1.03 billion. This positive trend extended beyond Bitcoin. Ethereum spot ETFs also saw robust demand, welcoming $479 million in inflows, their highest weekly amount since early October. BlackRock's fund, Ether, captured a significant share of this, drawing in $219 million. On a year-to-date basis, Bitcoin and Ethereum ETFs have amassed $1.21 billion and $584.9 million, respectively. Experts highlighted that the bulk of these inflows signify bullish stances, reflecting a resurgence of sticky institutional capital in the market. This signals a shift away from cash and carry arbitrage, which entailed simultaneous long positions in ETFs and short positions in CME futures, as their yields have reportedly diminished in appeal. As a result, Bitcoin's price has climbed by 6% to $92,600 this month, while Ethereum has rallied nearly 8% to $3,200, according to CoinDesk data. The correlation between ETF inflows and price movements suggests that institutional capital is actively shaping market structure rather than passively reacting to retail sentiment. This scenario contrasts sharply with late 2025, when Bitcoin faced challenges despite moderate ETF interest, CoinDesk's Market Insights model noted. The present dynamic indicates that institutions are positioning themselves ahead of potential regulatory clarity and macroeconomic shifts anticipated in the first quarter of 2026. It added, for Bitcoin and Ethereum prices to rise significantly in the forthcoming months, ETF inflows must maintain this momentum, following the outflow of billions in late 2025. We at BlockSonic perceive that the renewed institutional interest is a pivotal factor in the current market dynamics. How do you see the role of institutional investments shaping the future of crypto assets? We invite you to share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin by Bonanza. Strategies Saylor gears up for more. Bitcoin Bonanza. Strategy poised to amplify crypto holdings amidst market ripples. We at BlockSonic perceive an electrifying pulse as Saylor hints at yet another Bitcoin acquisition by Strategy. This comes shortly after the firm disclosed a monumental purchase worth $1.25 billion, elevating its holdings to over 687,000 Bitcoin. In a recent revelation on the social platform X, Saylor shared a captivating image from Strategy Tracker, displaying Bitcoin's value alongside indicators of the company's previous acquisitions. With the intriguing caption, "Bigger Orange." This follows Saylor's trend of cryptic signals preceding a formal announcement of substantial buys. Strategy kicked off the year with a purchase of 1,283 Bitcoin, valued at $115.97 million on January 4th, subsequently executing a more significant acquisition of 13,627 Bitcoin for $1.25 billion on January 11th. Since the dawn of 2026, the entity has augmented its assets by 14,910 Bitcoin, as recorded by Stratejacker. Currently, the company possesses 687,410 Bitcoin, with an average acquisition price of $75,353 per Bitcoin. As Bitcoin hovers around the $90,000 mark, Strategy's position remains lucrative on paper. Nevertheless, the journey has not been devoid of external pressures. The company's shares have underperformed in the past year, with stock prices plummeting from previous peaks. To finance these acquisitions, Strategy has engaged a variety of capital-raising mechanisms, including convertible note sales, which enhance leverage while maintaining modest cash expenditures. Bitcoin is trading slightly above $92,600 during Monday's Asian morning hours, experiencing a 2.6% decline in the past 24 hours as a tariff dispute between the United States and Europe impacts risk assets. We at BlockSonic understand that this maneuver by Strategy exemplifies the intricate dynamics between strategic asset acquisition and market volatility. Are we witnessing a calculated risk or a bold step into the future of decentralized finance? Dive into the conversation and share your insights in the chat. Bitcoin sways as tariff tensions ignite market waves. Gold surges to new peaks. A staggering $600 million in long Bitcoin positions were liquidated, prompting traders to recalibrate leverage and reassess their risk exposure. As dawn broke on Monday, the realm of major cryptocurrencies felt a shiver, a reaction to whispers of impending U.S. tariffs that soured the global investment climate. A cautious aura descended, igniting a widespread sell-off across the crypto landscape. Zola, at $133.97, tumbled over 6% within a mere 24 hours. Meanwhile, XRP staggered down roughly 4%, and Doge dropped more than 7%, as documented by CoinGecko's data. Ether wasn't spared, slipping by about 3% to hover near the $3,200 mark. Bitcoin, though showing some resilience, dipped below $93,000, marking a descent of approximately 2.5% for the day. The catalyst of this market turbulence was a proclamation by U.S. President Donald Trump, who declared over the weekend that beginning February 1st, the U.S. would levy a 10% tariff on goods from 8 European nations, a figure set to escalate to 25% come June unless a more comprehensive agreement arises. These tariff threats nudged investors towards safe havens, applying pressure on markets sensitive to risk. The crypto world mirrored the retreat seen in equities as U.S. equity index futures plunged dramatically in early trading, with Nasdaq 100 contracts down over 1% and European futures slipping as tariff anxieties reemerged. Asian markets presented a mixed picture, with most indices posting modest losses. In contrast, haven assets surged. Gold and silver attained record heights, while European government bond futures experienced an upswing. The dollar softened against several major currencies, signifying a defensive stance ahead of the U.S. trading session. The crypto sell-off was accompanied by a spike in liquidations. According to CoinGlass, a staggering $600 million in bullish crypto positions evaporated over the past 24 hours, predominantly impacting long positions. Bitcoin's open interest waned as traders scaled back on leverage. This upheaval follows a robust commencement to the year for cryptocurrencies. Bitcoin had ascended to just shy of $98,000 the previous week, buoyed by substantial inflows into U.S.-listed spot ETFs, with alternative cryptocurrencies mirroring the upward trend. Monday's retreat indicates a recalibration among traders as macroeconomic uncertainties assert their influence. The weight of the selling was heaviest on altcoins, a frequent pattern during risk-off periods, prompting traders to pivot from higher beta tokens to more liquid assets. Market observers are now focused on whether Bitcoin will maintain its footing near the $90,000 threshold, a critical point that could dictate the extent of this pullback or its stabilization. As we navigate this climate, We at BlockSonic perceive that crypto markets are intricately linked with global risk sentiment, making prices acutely responsive to developments in trade, geopolitics, and monetary policy. In this swirling dance of markets, do we see Bitcoin holding its ground, or are we witnessing the onset of a deeper correction? We invite you to share your insights and join the discussion, adding your voice to the rhythm of this ongoing narrative. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin's dramatic tumble. Unraveling at 92,000. Leverage unleashes chaos. Crypto markets fragile dance amid weak demand. As the sun rises over Asia, we witness Bitcoin's descent, slipping approximately 3% to hover near $92,500, revealing the frailty of a derivatives-fueled surge. Despite whispers of late 2025's easing sell pressure, the world's leading cryptocurrency retreats from its recent foray into the mid-$90,000 range. CoinGlass unveils the staggering liquidation of over $680 million in crypto stances within the past day, with approximately $600 million vanishing from long positions, a testament to the crowded bullish aspirations post-rally. Altcoins face a tempestuous Monday morning in Asia, with Solana descending 6.7%, Sui plummeting 10%, and Zcash mirroring the 10% drop. Amidst this turmoil, gold ascends, climbing 1.7% to $4,600. As a new 10% tariff materializes on Denmark and 7 other European nations, pending a complete and total agreement on Greenland's acquisition. Glassnode's weekly insights reveal Bitcoin's journey toward $96,000 was predominantly propelled by mechanical derivatives flows, including short liquidations, rather than enduring spot accumulation. The analytics firm highlights the tenuous nature of futures liquidity, exposing price movements to abrupt reversals once compelled buying dissipates. It also identifies a congested supply zone forged by long-term holders who amassed near cycle zeniths, a recurring cap for recent resurgences. CryptoQuant's latest report adopts a more skeptical stance, portraying the movement since late November as a potential bear market rally rather than the dawn of a new uptrend. According to CryptoQuant, Bitcoin lingers below its 365-day moving average, near $101,000, a level historically serving as a regime boundary. Although demand conditions have marginally improved, they remain largely unaltered, with visible spot demand contracting and United States spot exchange-traded fund inflows remaining modest. Hints of stability emerge as Glassnode observes a significant slowdown in long-term holder distribution compared to late 2025, while major exchanges like Binance see more dominant spot flows from buyers. As Coinbase-led selling diminishes, options markets echo the uncertainty, with implied volatility staying low, yet downside protection remains priced into longer-term contracts, indicating investor caution. We at BlockSonic understand that until robust spot demand resurfaces, Bitcoin will likely continue to be vulnerable to leverage and liquidity fluctuations, keeping investors alert. In this volatile dance of cryptocurrencies, how do you perceive the shifting tides? We invite you to share your insights and join the conversation in the chat. Bitcoin's new dawn, infrastructure over hype. The crypto world moves past political hype, focusing on infrastructure and real use, shaping the future of Bitcoin and blockchain technology. Throughout the year 2025, the crypto market seemed to lean heavily on the notion of U.S. President Donald Trump as a crypto savior. Prices surged ahead of policies, altcoins banked on political favors, and the industry awaited a regulatory nod that did not materialize. As the year concluded and Trump's return to office became just a memory, the market diverged from the expected path. We at BlockSonic understand that this shift signifies a crucial turning point in the crypto world. The future of crypto is less about politics and more about solid foundations. Institutional capital is reshaping market behavior, promoting Bitcoin as a reserve asset, and urging altcoins to demonstrate real-world utility. Simultaneously, crypto is merging with artificial intelligence, forming the backbone for autonomous systems and digital commodities. With the return of consensus to Hong Kong, the city stands uniquely poised at the intersection of global finance and emerging technology. Though Trump's stance on crypto is positive, he is not the industry's main focus. The past year highlighted how much of crypto's momentum relied on expectations rather than fundamentals. We at BlockSonic interpret that this recalibration is occurring as institutional capital becomes a defining force in the crypto markets. Investors are shifting away from election-driven trading, viewing crypto as a long-term asset class, influencing market dynamics significantly. This structural transition forces a re-evaluation of value distribution within crypto markets, especially the relationship between Bitcoin and other digital assets. Bitcoin holds the role of a reserve asset akin to gold, while altcoins integrate into the productive economy. Animoca Brands aims to be the first digital asset treasury company focused on altcoins, aspiring for a NASDAQ listing. We at BlockSonic perceive that crypto and artificial intelligence are converging, not competing, with blockchain offering the trust and sovereignty needed for autonomous systems. For many, the hedge against AI is owning crypto, which serves as the natural asset class for AI agents. These agents require secure, immutable rails for managing assets and executing transactions. This convergence reflects earlier tech cycles, where the infrastructure quietly powered entire industries. Just as e-commerce became simply commerce, crypto is becoming an integral part of finance. We at BlockSonic assimilate that the shift towards new users is also transforming the presentation of finance. Rather than embedding financial products into games, crypto is adopting gaming culture, engaging younger generations who grew up online. Leaderboards and reward systems are not mere design elements, but represent how younger users perceive participation and value. Hong Kong, with its international capital markets and proximity to advanced tech ecosystems, is well positioned for this next phase. A global digital assets hub must have global connectivity, and Hong Kong offers just that. As we move forward, we ask, what does this shift toward infrastructure over hype mean for your engagement with crypto? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin surge and whale accumulation. A crypto resurgence. Bitcoin's big players boost holdings in record numbers. In the wake of recent market fluctuations, we at BlockSonic have observed a significant increase in Bitcoin accumulation by major holders, marking the most substantial growth since the dramatic FTX collapse of 2022. Over the past 30 days, a specific group known as the Fish-to-Shark cohort has added approximately 110,000 Bitcoin to their holdings, according to insights from Glassnode. This marks the largest accumulation since Bitcoin's significant drop to the $15,000 range over 3 years ago. As Bitcoin navigates a constrained price range, it hovers roughly 25% below its peak in October, yet sits around 15% higher than its November low of approximately $80,000. The Fish-to-Shark cohort, which includes high-net-worth individuals, trading desks, and some institutional investors, now controls nearly 6.6 million coins, up from about 6.4 million 2 months prior. Meanwhile, smaller investors are also expanding their Bitcoin holdings. The shrimp cohort, representing retail investors with less than 1 Bitcoin, is a diverse and highly responsive group that reacts to market volatility and sharp price changes. In recent weeks, shrimps have acquired more than 13,000 Bitcoin, marking the largest increase since late November 2023, bringing their total holdings to approximately 1.4 million coins. Both large and small investor groups seem to be recognizing intrinsic value, suggesting a widespread demand across the cryptocurrency market. We at BlockSonic understand that this trend indicates a renewed interest and confidence in Bitcoin's potential value. We at BlockSonic perceive that both individual and institutional players are positioning themselves strategically within the market, signaling a broader recognition of Bitcoin's long-term promise. How do you view this resurgence in Bitcoin accumulation? We invite you to join the conversation and share your thoughts in the chat. Bitcoin ETF Inflow sparks new crypto bullishness. Massive Bitcoin ETF inflow reveals a seismic shift in investment strategies, signaling a bullish trend for cryptocurrencies. The 11 spot exchange-traded funds listed in the United States have witnessed an astonishing net inflow of $1.2 billion so far this month, reversing the redemptions seen in December, according to data from Value. As we delve deeper into the numbers, we uncover a compelling narrative. Large investors are moving away from complex arbitrage strategies and increasingly favoring the potential of a long-term price upswing in Bitcoin. Historically, big investors employed a strategy known as cash and carry arbitrage to profit from Bitcoin trading, leveraging the pricing mismatch between spot and futures markets. However, the recent inflows into United States listed spot Bitcoin exchange-traded funds suggest a shift towards more straightforward, directional bullish bets, steering clear of sophisticated arbitrage plays. Imagine buying a gallon of milk for $4 today because someone has agreed to buy it from you for $5 next month. The price of milk fluctuating doesn't matter since you've locked in a $1 profit. Similarly, in the crypto realm, investors bought spot Bitcoin exchange-traded funds and shorted Bitcoin futures, focusing not on Bitcoin's price rising, but on pocketing the tiny price difference between the two. With the narrowing gap between now and later and rising costs of funding such trades, the allure of this strategy has waned. This data suggests that large investors continue to seek Bitcoin exposure, opting for traditional bets on potential long-term price rallies. While United States spot exchange-traded funds have seen a net inflow of $1.2 billion, the total number of open or active standard and micro Bitcoin futures contracts on the CME has surged by 33% to 55,947 contracts. This mix of exchange-traded fund inflows and expanding CME open interest typically aligns with cash and carry arbitrage. Nonetheless, these latest inflows likely aren't linked to carry trades, as the price gap between CME futures and spot exchange-traded funds has tightened to levels that scarcely cover transaction costs and funding expenses. This perspective is bolstered by the currently subdued front-month basis of roughly 5.5%. After accounting for funding and execution costs, the implied carry appears nearly zero, offering limited incentive to re-engage in the trade. Mark Pilipchuk, research analyst at CF Benchmarks, mentioned in a Telegram message to CoinDesk. One reason could be the recent dull price swings in Bitcoin. Since its significant drop from an all-time high in October last year, Bitcoin's price has hovered around $90,000. Low volatility, reduced price mismatch opportunities, and less profitable trading gaps are evident in the data. Bitcoin's annualized 30-day implied volatility, as represented by Volmex's BVV index, has dipped to 40%, the lowest since October, indicating that expectations for price turbulence have hit a 3-month low. According to analysts at cryptocurrency exchange Bitfinex, this marks a significant shift in market microstructure, bullish for Bitcoin. Make no mistake, investors continue to pour into spot exchange-traded funds, as evidenced by the $1.2 billion inflow. Yet, the bets now aim for direct price upside in longer-term investments. Bitfinex analysts dub these new investors sticky, as they aren't in for quick profits based on price gaps, but are committed for the long haul, given the vanished volatility. Essentially, big institutions feel safer diversifying funds into alternative assets like Bitcoin, which has lagged other assets such as precious metals and equities. Institutions typically add longer-term exposure during low volatility phases, and as liquidity gradually shifts down the risk curve following rallies in gold and silver, analysts explained regarding the exchange traded fund inflows. Simply put, these investors aren't in for fast money, seeking quick gambles. It's sticky money from serious investors committed to the market for the long haul. Who are these sticky investors betting on upside, not setting up arbitrage bets? The data reveals how much investors are shorting Bitcoin. In CME-listed Bitcoin futures, open interest has surged, fueled by speculators betting on a bullish outcome, rather than shorting as part of carry trades. Non-commercial traders, or large speculators, are aiming for profits rather than hedging risks, indicating increased bullish exposure, leading to recent open interest growth. Participation from non-commercial traders, a category capturing more speculative capital, has risen significantly. Open interest in CME Bitcoin futures held by this group has climbed to over 22,000 contracts, aligning with the recent improvement in price sentiment. Benchmark's Pilipchuk noted. This suggests that the recent open interest expansion is driven primarily by institutional speculators like hedge funds seeking long-term Bitcoin price upside via the regulated futures market, rather than a re-leveraging of basis trades. He added. He further highlighted that leveraged funds, or hedge funds, typically short futures as part of carry trades, have steadily reduced short exposure. We at BlockSonic understand that this shift in investment strategy reflects a growing confidence in Bitcoin's long-term potential. As institutional interest swells, we at BlockSonic perceive a fascinating evolution in the crypto landscape. What does this mean for the future of Bitcoin and crypto investments? We invite you to share your thoughts and join the conversation in the chat. Wall Street's crypto awakening. Bitcoin's next big leap. Crypto's revolutionary shift. The new global financial era. In the vast landscape of finance, digital assets are quietly transitioning from niche experiments to essential components. As we set our sights on the year 2026, a pivotal moment unfolds, one that could redefine the broader market's perception of these assets. This perspective comes from Fidelity Digital Assets through their latest 2026 Visionary Insights report. They paint digital assets as experiencing a monumental transformation akin to historic shifts in global trade. Chris Kuiper, Fidelity's Vice President of Research, captures this sentiment vividly in a recent conversation with CoinDesk. Digital assets are nearing what I call their shipping container moment, Kuiper remarked, referencing Mark Levinson's book, The Box, which illustrates how a simple metal container revolutionized global trade by transforming ports, logistics, and supply chains. This seemingly mundane evolution was decades in the making, much like what we now witness in finance. While 2025 appeared stagnant on price charts, Fidelity's analysis suggests a hidden story of infrastructure redesign, regulatory framework development, and institutional strategy refinement, all setting the stage for a breakout in 2026. This transformation unfolds quietly through regulated offerings, secure custody solutions, and strategic institutional involvement. Besides, a wave of announcements from leading banks and brokerages in 2025, signaling their dedication to digital asset capabilities. Every significant bank declared their intention to develop digital asset capabilities last year, he noted. It requires time, and immediate results aren't visible, Kuiper explained. But what's unmistakable is that this movement is here to stay. A notable cultural shift occurred in 2025 as market participants stopped proclaiming Bitcoin dead for the first time in history. Kuiper sees this as a symbol of broader acceptance, marking a transition from speculative fringe to a foundational technological future. Digital assets inch closer to merging with capital markets through exchange-traded products, derivatives, tokenization, and evolving legal frameworks, making them accessible to a broader investor base. Tokenization involves converting real-world assets into blockchain-based tokens. Institutions, as Kuiper envisions, will continue propelling this evolution. Fidelity anticipates firms increasing synthetic exposure, participating in digital asset returns through derivatives and structured products, all while Bitcoin maintains its traditional appeal as a reserve asset. Strategic enterprises are likely to keep accumulating Bitcoin reserves, while conservative corporate treasuries take initial steps into the space, as predicted by the asset manager. Behind these decisions lie slow-moving yet influential capital allocators. Pensions, endowments, and foundations, the traditionally cautious segments that recently embraced crypto allocations. The substantial funds, pensions, endowments, they have boards and extensive approval processes, Kuiper noted. Yet, the foundation is shifting. Harvard's endowment gaining attention for its digital asset exposure last year may be just the beginning. A quieter yet potentially massive trend is emerging in the advisory ecosystem, according to Kuiper. While many U.S. financial advisors could technically offer Bitcoin and other digital assets, the process has been cumbersome, filled with obstacles and risk tolerance hurdles. That's evolving. Wealth managers and registered investment advisors are poised to offer crypto to more clients, Kuiper stated. With tens of trillions of dollars under advisement across registered investment advisors and wirehouses, even a gradual, multi-year adoption signifies a structural shift that many overlook. One of the most underestimated growth drivers in this space is the ongoing adoption of crypto offerings by financial advisors for everyday investors, whether through exchange-traded products or direct holdings. This multi-year trend could equate to tens of trillions of dollars and reshape the investment landscape for years, he added. This transformation is crucial, as advisors consistently allocating to Bitcoin and other assets will create a stable market demand, differing fundamentally from the volatile, sentiment-driven cycles of earlier years. While not instantaneous, it is persistent. Fidelity's research also delves into emerging technological challenges that may shape 2026. Quantum computing's impact on cryptographic security, and the rise of quantum-ready solutions in custody and infrastructure. As new blockchain layers and tokens position themselves as quantum-resistant, custodians prepare to stay ahead of evolving security needs. On the regulatory front, Kuiper highlights ongoing U.S. market structure legislation that could be pivotal for institutional integration. Should it pass, it could pave the way for traditional finance players and intermediaries to gain the green light to continue building, he said, potentially accelerating bridges between crypto and legacy markets. What should markets anticipate in 2026? Kuiper's vision isn't about fireworks, but rather foundation building. 2026 may follow a similar path to 2025. With digital assets continuing to integrate into the traditional financial system. Continued regulatory clarity could potentially accelerate momentum, enabling ongoing institutional participation. Over time, capital from pensions, endowments, and foundations could steadily enter the digital asset space as regulatory barriers evolve, he stated. This aligns with Fidelity's research view that despite a flat price in 2025, structural tailwinds from pension allocations, regulatory clarity, and deeper market infrastructure suggest digital assets may be poised for renewed all-time highs next year. If Bitcoin's shipping container moment arrives, it won't be due to sudden price spikes, but because a comprehensive financial ecosystem, long in the making, finally aligns. We at BlockSonic perceive that this narrative reflects a profound shift in the financial landscape. The question we pose to you is, how do you envision participating in this transformative journey? Share your thoughts and join the conversation in the chat. Crypto bill shakeup, Coinbase's bold move. Crypto titans clash over bill. Chaos unleashed. The crypto landscape stood at the brink as U.S. lawmakers prepared for a pivotal hearing on a major bill set to redefine how federal regulators like the Securities and Exchange Commission and the Commodity Futures Trading Commission would oversee crypto markets. But just before the hearing, Coinbase, a leading crypto exchange deeply embedded in the bill's negotiations, and a significant lobbyist, unexpectedly withdrew its support, sending ripples throughout the industry. This decision threw the crypto world into disarray. Mere hours later, the United States Senate Banking Committee canceled the scheduled hearing, which was set to begin in just over 12 hours. In response, lawmakers resumed discussions, with key industry figures joining dialogues to navigate the emerging turmoil. Coinbase's withdrawal wasn't isolated. Let's explore the widespread concerns about the bill, based on insights from 6 industry insiders interviewed by CoinDesk throughout the week, both before and after the hearing's cancellation. Many industry participants feared that the bill's provisions would hinder crypto startups' ability to launch tokens or operate decentralized projects. Key concerns revolved around how decentralized finance would be regulated, stablecoin yield provisions, and the Securities and Exchange Commission's oversight of certain crypto securities. Alarmingly, some provisions threatened to shift blockchains towards permissioned systems, undermining their open access nature. Additionally, the rapid timeline for reviewing the bill and its amendments was a significant issue. Released just before midnight on Monday, amendments were due by 5 p.m. the next day, leaving a scant 17 hours for companies to digest its contents before the Thursday hearing. This accelerated timeline left little room for thorough analysis. It's important to note that the industry wasn't unanimously opposed. While Coinbase's CEO, Brian Armstrong, voiced his disapproval on X, several other crypto executives expressed support for the bill and the markup hearing. The provisions concerning decentralized finance particularly blindsided many industry stakeholders. These last-minute additions applied anti-money laundering and know-your-customer regulations to decentralized finance, potentially stifling true decentralization by enforcing centralized compliance. The bill also proposed expanding the Bank Secrecy Act to encompass decentralized finance, possibly hindering these projects from operating as truly decentralized entities. As a result, centralized companies would be required to manage compliance, contradicting decentralized finance's core principles. Concerns were also raised about the U.S. Treasury Department's authority to restrict interactions between self-hosted wallets and exchanges. Blockchain Association CEO Summer Mersinger highlighted how the bill risked enveloping decentralized finance infrastructure within the regulatory frameworks of the Securities and Exchange Commission and the Treasury Department. citing broad provisions related to anti-money laundering compliance. Stablecoin yield emerged as a particularly contentious topic. The banking lobby secured provisions limiting digital asset platforms from offering yield rewards outside user activities like transactions and staking. While some viewed this loophole as undermining broader restrictions, others saw it as a significant limitation. Amendments to tighten stablecoin yield provisions were also on the table, with bipartisan concerns about allowing yield activities. Negotiations suggested that further restrictions on stablecoin yield offerings were likely. This debate pitted traditional banks against crypto innovations. While banks adhere to stringent regulations and Federal Deposit Insurance Corporation backing, stablecoin companies lack equivalent requirements. Treating stablecoin deposits akin to bank deposits could further restrict issuers and exchanges' ability to offer rewards. The bill also empowered the Securities and Exchange Commission with extensive authority over network tokens, requiring projects to prove their tokens aren't securities. Critics argued this hampered the flexibility of both the Securities and Exchange Commission and the Commodity Futures Trading Commission in approaching digital assets. Despite granting such authority, the bill limited the Securities and Exchange Commission's ability to exempt certain digital assets from disclosure and registration requirements. The broad definition of common control raised concerns about its implications for distributed ledger systems. Tokenized assets face potential treatment akin to traditional securities, posing challenges for crypto firms. While Coinbase's Armstrong described this as a de facto ban on tokenized equities, representatives from the tokenization sector challenged this view, asserting that the bill treated tokenized securities as any other security under the Securities and Exchange Commission's jurisdiction. Amendments to the bill's text raised additional alarms. Proposals like Senator Angela Alzabrook's called for rulemakings, deposit outflow studies, and anti-evasion regulations, potentially adding prohibitive measures. Critics noted that these changes could lead regulators to conclude existing statutes were insufficient, while anti-evasion provisions impose strict penalties for noncompliance. The bill faced resistance from lawmakers, with bipartisan concerns about stablecoin provisions, particularly from states with numerous community banks. Democrats sought assurances for bipartisan leadership at federal regulatory agencies. The ongoing debate over an ethics provision preventing President Donald Trump from profiting from his crypto ventures while in office added another layer of complexity. Senator Ruben Gallego led negotiations with Republican Senator Cynthia Lummis. The White House crypto advisor Patrick Witt's absence from key discussions was noted. While discussions resumed, the markup hearing remained unscheduled, and changes to the bill were anticipated. The process, however, continued to evolve. We at BlockSonic perceive a landscape where crypto innovation clashes with regulatory evolution. Will regulations stifle or nurture the decentralized future we strive for? Share your thoughts and join the conversation in the chat. Bitcoin's meteoric rise and stablecoin surge, a glimpse into 2026. A bold prediction, crypto adoption and market shifts set to transform the Bitcoin landscape by 2026. As we peer into the horizon of 2026, we, alongside seasoned crypto investor Dan Tapiro, foresee a vibrant landscape for crypto assets. For those contemplating a $10,000 investment, Tapiro suggests a balanced approach, distributing funds between Bitcoin, Ethereum, and Solana, tailored to personal preferences. Beyond individual portfolios, Tapiro highlights the profound potential within the crypto infrastructure, which is making significant strides into the mainstream. Stablecoins in particular are revolutionizing global payments, with transaction volumes expected to soar to $33 trillion by 2025, up from $19.7 trillion in 2024. There is an entire universe evolving, Tapiro notes, as traditional financial players seek to integrate stablecoin frameworks into their operations. At the helm of 50T funds, Tapiro champions Bitcoin's role as both an investment and a macroeconomic safeguard. He anticipates Bitcoin reaching $180,000 in this cycle, driven by escalating demand and global monetary dynamics. Tapiro interprets recent market corrections as mere adjustments, affirming the market's foundation. He perceives powerful forces at play, including declining interest rates and substantial spending on artificial intelligence infrastructure, leading to the devaluation of fiat currencies worldwide. This scenario is incredibly bullish for Bitcoin, he asserts. While Tapiro remains optimistic about the growth potential in tokenization, blockchain artificial intelligence synergies, and on-chain prediction markets, he exercises caution regarding the rise of crypto treasury firms, questioning their long-term value. There is no competitive edge, he remarks. I struggle to see the enduring value proposition for 95% of them. Tapiro's conclusion is that the crypto realm in 2026 is still nascent, yet maturing rapidly, driven increasingly by practical applications rather than mere speculation. The accelerated ascent of stablecoins and financial innovations, Tapiro explains, is fueled by the fundamental priority of money in these sectors. We at BlockSonic understand that these insights reflect the evolving rhythm of the crypto world. How do you perceive these shifts in the crypto landscape? Share your thoughts and join the conversation in the chat. White House crypto drama, Coinbase denies pulling support. In a twist for the crypto world, Coinbase asserts positive White House involvement in Bitcoin discussions. Amid swirling rumors, we at BlockSonic perceive that Coinbase's chief executive officer, Brian Armstrong, has firmly countered claims concerning the White House's stance on the crypto market structure bill. Contrary to reports, Armstrong states that the White House has been super constructive in its approach. Armstrong shared that the White House encouraged Coinbase to negotiate with banks, and we at BlockSonic understand that these discussions are actively in progress. This move is aimed at fostering community banks, an often overlooked segment in digital asset discourse. Speculation intensified following a post by journalist Eleanor Terrett, claiming the White House might withdraw support for the bill unless Coinbase secures a bank-friendly agreement. Yet, Armstrong's response highlights ongoing efforts to craft solutions benefiting community banks, showing a path of collaboration rather than conflict. The banking sector and crypto community found themselves in a standoff when Coinbase, a major crypto exchange and active participant in bill negotiations, unexpectedly pulled its support. This decision disrupted the industry and sparked debates on whether banks were attempting to stifle the bill to eliminate competition. The tension led to the U.S. Senate canceling a crucial hearing just 12 hours before it was set to begin. In light of these developments, we at BlockSonic interpret Armstrong's comments as an indication that lawmakers are not hindering progress, but are instead seeking to harmonize the interests of both the crypto and banking sectors. As we navigate these complex dynamics, we at BlockSonic pose this question: how can we best achieve a balance that respects the autonomy of crypto while accommodating the interests of traditional banking? Share your thoughts and join the conversation with us in the chat. Bitcoin, the ultimate decentralized diversifier for bold investors. Unlocking Bitcoin's decentralized potential for unrivaled portfolio growth. In the realm of institutional investments, we at BlockSonic perceive Bitcoin's evolving role as a catalyst for diversification, as emphasized by ARK Invest's CEO, Cathie Wood, in her 2026 market forecast. Wood's insights highlight Bitcoin's distinct lack of correlation with traditional asset classes such as gold, equities, and bonds. This characteristic, she notes, positions Bitcoin as an essential asset for allocators seeking enhanced returns relative to risk. ARC's findings suggest that since 2020, Bitcoin has exhibited minimal price correlation with stocks, bonds, and even gold, compared to their correlations with each other. For instance, Bitcoin's correlation with the S&P 500 stands at 0.28, whereas the S&P 500's correlation with real estate investment trusts is 0.79. This data underscores Bitcoin's potential as a superior diversification tool. For significant institutional investors focusing on risk-adjusted portfolios, Bitcoin's role extends beyond mere speculation, according to Wood. Her bullish stance includes a projected price target of approximately $1.5 million by 2030, demonstrating her confidence in Bitcoin's long-term value proposition. Interestingly, while Wood maintains her optimistic view, Jefferies strategist Christopher Wood recently reversed his stance on Bitcoin, opting instead for gold, due to potential security concerns with advances in quantum computing. Despite Jefferies' pivot, Cathie Wood's perspective aligns with other financial powerhouses. Morgan Stanley's Global Investment Committee advocates for a strategic Bitcoin allocation of up to 4%, and Bank of America supports a similar approach. Additionally, CF Benchmarks considers Bitcoin a staple for portfolios, with conservative allocations potentially enhancing efficiency through improved returns and diversification. Brazil's largest asset manager, Itaú Asset Management, suggests a modest Bitcoin allocation as a hedge against foreign exchange and market fluctuations. We at BlockSonic understand that Bitcoin's decentralized nature offers a distinct advantage in portfolio diversification. Could this be the era where Bitcoin becomes an institutional mainstay, redefining the landscape of asset allocation? Join the conversation and share your thoughts in the chat. Crypto's liquidity crisis, a looming threat to Bitcoin's future. Before the Hong Kong crypto consensus, Auro's Jason Atkins highlights that market depth, not hype, will shape Bitcoin's next chapter. Throughout the past year, the crypto sphere has been buzzing about institutional interest. However, a recurring issue lurks beneath the surface. The current market lacks the liquidity needed for Wall Street's grand entry without disrupting Bitcoin prices. Ahead of the Hong Kong crypto consensus, Jason Atkins, the chief commercial officer at crypto market maker Oros, emphasized that illiquidity, rather than volatility, is the key structural challenge facing the industry. You cannot just claim institutional capital is eager to join without providing them a suitable entryway, Atkins stated. The pressing question, he pointed out, is whether the markets can handle the sheer volume of institutional demand. It is one thing to say, "We have convinced them to come now," Atkins continued. But do we have enough seats in the vehicle? Atkins explains that crypto markets are illiquid not due to a lack of interest, but because significant deleveraging events, such as the October 10th crash, have expelled traders and leverage from the system more quickly than they can return. Liquidity providers react to demand rather than generate it, leading to reduced trading activity and prompting market makers to reduce risk. This thinning of depth contributes to heightened volatility, which then triggers stricter risk controls and further liquidity withdrawal. According to Atkins, institutions are structurally incapable of acting as stabilizers in thin markets, resulting in a lack of natural support when stress hits. This creates a self-perpetuating cycle where illiquidity, volatility, and caution reinforce each other, keeping markets fragile even as long-term interest persists. Volatility itself, Atkins noted, is not what dissuades large allocators. The real issue arises when volatility meets thin markets. Managing volatility is challenging in illiquid markets, Atkins remarked, as positions become difficult to hedge and even more challenging to exit. This dynamic, he emphasized, is much more critical for institutions than for retail traders. Large allocators operate under stringent capital preservation, mandates that offer little tolerance for liquidity risk. When you possess substantial wealth, or if you are a massive institutional player, Atkins said, it is not about, can you maximize yield? It is, can you maximize yield in relation to capital preservation? Atkins also countered the notion that capital is merely shifting from crypto to artificial intelligence, asserting that the two are not at the same point in their cycle. While artificial intelligence has been around for years, Atkins noted that its surge in investor attention is relatively recent and is not causing capital inflows to Bitcoin to dry up. By contrast, crypto is further along in its cycle and is now experiencing consolidation rather than novelty. I believe that the industry has reached a consolidation phase, Atkins said, adding that there is not as much financial innovation occurring. Many of crypto's core primitives, he noted, are no longer novel. Uniswap and AMS, and the AM model is not a new concept, he said. The slowdown in crypto liquidity is less about funds being withdrawn, and more about the absence of new structures that attract sustained interest. Crypto, Atkins said, is experiencing its moment. In his view, the liquidity issue is structural rather than cyclical or about a new risk asset siphoning capital from others. Until markets can accommodate volume, hedge risk, and exit cleanly, new capital will remain cautious. Interest may still exist, Atkins said, but liquidity, not narrative, will determine when it can act. We at BlockSonic understand that the delicate dance between liquidity and volatility holds the key to Bitcoin's future. Can the crypto world rise to the occasion and nurture the depth it so desperately needs? Share your thoughts and join the conversation. Thank you so much for following BlockSonic today. See you in the next live session with more news, analysis, and market alerts. Don't forget to follow our channel and turn on notifications. See you soon. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.